On the sidelines of IMF and World Bank meetings in Washington, D.C., Nigeria's delegation led by the Central Bank of Nigeria Governor Olayemi Cardoso hosted investors to discuss the positive impact of reforms in the economic metrics of Africa's most populous nation. The forum, in collaboration with financial advisors JP Morgan, Citibank, Standard Chartered, Chapel Hill, Denny, dubbed Nigeria Day presentation, was an opportunity for Nigeria's economic team to engage with foreign investors and field questions on fiscal and monetary policy.
It's a pleasure to be here in Washington, D.C. at this year's Nigeria Investor Forum, held on the sidelines of the IMF World Bank's 4 meetings, a valuable opportunity to engage directly with our partners and investors who continue to show confidence in Nigeria's future. The Honorable Minister of Finance, who was meant to join us today, is unwell, but thankfully recovering well. The great thing about having a strong and well-coordinated economic team is that the work continues seamlessly. The Central Bank and the Ministry of Finance have been working hand in hand to ensure alignment, stability, and clarity for investors. Nigeria's focus remains clear: strengthening our fundamentals, advancing reforms, and unlocking opportunities for sustainable investment and growth. We are encouraged by the progress made so far and remain confident that the ongoing reforms are laying a stronger foundation for a more resilient and globally competitive economy. On that note, I'll now hand over to Ms. Sonyade Okoli, Special Advisor to the President on Finance and the Economy, and Mr. Mohammed Sani Abdullahi, Deputy Governor Economic Policy, who will take us through the investor presentation.
If you step back and look at the trajectory that we've been following over the last couple of years, you'll see that it really has been about creating this foundation for growth. In the first instance, it was doing the reforms that removed distortions and then also tried to reestablish macroeconomic stability. So reforms, really, let's look at it in a few broad buckets. The economic and institutional reforms, so for example, security, much improved in the Greek area and also in the oil and gas space. We've increased the transparency of data. In fact, I will use this opportunity to say, the monetary side, you've seen, it's quite interesting to have been at these sessions over a period of time, because a year ago, one of the most common questions is, what's your net reserves? You now have the answer to questions such as the net reserves. On the fiscal side, we still keep pushing. We're not exactly where we want to be, but we're certainly not where we used to be. There's a fiscal coordination committee that was set up earlier in the year, and we've been spending time working across the various relevant institutions to ensure that, one, we have aligned performance reporting, so you're getting one data from the Nigerian government and not different pieces of data, and you're trying to reconcile the different ones, and what does the Accountant General mean by revenues versus what does the Budget Office mean by revenues.
From the monetary policy and external position, I think it's good to put our heads back to a year and a half ago when we were in this room, I believe, during the spring meetings of 2024. And at that time, the economic conditions of mid-2023 were really still upon us, and we had average parallel FX market premium of over 50%. We had $7 billion in foreign exchange backlogs. We had a complete collapse between 2019 and 2023 of capital importation of over 75%. Food inflation went all the way up to over 40%. Headline inflation went all the way up to about 35%, and the ratings from the various agencies was really not in a good place. So it's good, as Sayede has mentioned, to really come back to these events and have a conversation about where we are today. We have a much more stable currency, where, as you see, in 2022, the FX market, the parallel market premium was 52%. As of now, it's less than 3%, and the currency has stabilized over a long period of this year in particular. There's been a lot of work that has gone on in partnership with the fiscal side in terms of increasing oil production, growing non-oil exports, improving remittances inflows, and also, given the strength of the currency, that we've seen a lot of increased domiciliary account conversions and a much more, as much as possible, efficient foreign exchange market which has been built, which is transparent, which is ethical, and has seen a lot more flows coming in.
So capital gains, as part of the reforms, we're trying to address issues around arbitrage and distortion, where you have to spend time. We have cases in court where you have to decide whether your gain is income, capital, revenue. We thought it wasn't necessary. Number two, we wanted the regime to be progressive so that low-income earners, small investors don't have to pay tax. But if you make a lot of money, it's fair to pay something. We also recognize that with the reform going around globally, around Pillar 1, Pillar 2, if you're familiar with it, and minimum tax, really means if you make money in Nigeria and you don't pay tax there, you will pay it in your home countries. So why do we want to lose our tax base to another country? One other thing we've done is to reduce your risk as an investor. Before, you will pay capital gains tax at 10% on isolated gains. Your losses were ignored. The reform says we do net. So that takes away your risk of paying taxes on Naira isolated gains. So we think that overall, also because we're reducing the corporate tax rate for businesses, we're enhancing their input credits for VAT on assets and overhead that they never got before. When you enhance the profitability and the cash flow of businesses, the valuation will even go up much more than the extra amounts you need to pay on capital gains. So we're continuing to engage. We're currently working on the guidelines to implement. We'll be very much interested in your input to strike a balance that we're all happy about.
Let me first say, one of the reasons we have these meetings is I would like to have opportunities to interact with everybody before we then show up with a deal, because we know that a number of you invest in both the local securities as well as the international ones. So let's just say, as you know, again, our borrowings are guided largely by the budget. So for 2025, we've almost completed the domestic borrowings. You know all the securities that we issue in the market, and some of you will see your bids, and we appreciate them, and thank you for believing in the Nigeria story and the journey that the government has embarked upon. Last year, December, you know, we were in the market, same delegations almost, for Eurobonds in December. So what we're doing today is really updating some of what has happened since then. Okay, so there's new external borrowing in the budget, and in US dollar terms, it's about $1.2 billion. Then some of you would also know that we have a maturing Eurobond in end of November. It's about $1.118 billion. Some of you are invested in that as well. So what we are working towards, subject to market conditions and subject to the advice of our transaction parties, is to be in the market later this year to issue Eurobonds for a total amount of $2.3 billion. Okay, for tenors, that will be determined closer to the time, as you know, but Advisors, as usual, will engage with a number of you and work out the tenor that is good for you, but also good for us in terms of liability management and pricing.
The dynamism of the way we do our market operations, as you can see, is getting a lot more efficient. So we do mop up liquidity on a daily basis because we have the standing deposit facilities where we take liquidity out of the market at very, very attractive rates for now. And that really is a primary tool, as well as OMOs for mopping up liquidity. So although the market had gotten fixated on OMOs for so long, we're now trying to get a bit more efficient in the way we do our monetary operations for it to be a lot more effective. And as we move to the shorter end of the market, also with the interest rate outlook, it does make sense for us to play short. Whilst rates come down, they will go longer. Sammy sort of answered you, right? Because again, conditions have now normalized or are normalizing now. The outlook is very positive. So we do expect or encourage investors to now move to the longer end of the curve, play more in the bond market, equities market, buy houses, beachfront villas, whatever you need to do in Nigeria. So that because the economy is a lot more stable, the outlook is a lot more positive, and then we're changing the mix. We do appreciate the role of the short-term strategy of attracting the monies to come into the short end of the market. But now we're past that hump. The reserves are strong, the buffers are much stronger, and we think the story is a lot more positive. So that really is the combination of the way we're playing it. But we remain